I'd like to welcome everyone to FarmFirst Dairy Risk Management webinar. Thank you for joining us. We're glad to be able to bring this meeting to you virtually, considering everything that's been going on, and that no matter where our members are, distant or members or dairy farmers anywhere, that they're able to join this webinar we brought forward today. Our FarmFirst leadership, meaning our board of directors and staff, recognized that there was, a need to make sure that dairy farmers understood what tools are available to them. That's where this idea grew out of. So this is meant for dairy farmers today. So if you have a question, please let us know. The way that we're going to handle that today is at the end of the webinar. So if you have a question, I encourage you to write it down or submit it right away. There's a feature in the webinar that's called Q&A. If you go to the bottom of your screen, you can see that Q&A. Just click on that, and then you can type in any questions you have. You're also welcome to email me, which is, I don't have it up, but if you want to write it down, it's jsweney@farmfirstcoop.com. So between the Q&A, and I'll try to watch my email, we'll try to get all your questions answered at the end of the webinar. We have today with us Mark Stephenson from UW-Madison and Travis Glaser from ARM Services, Ag Risk Management Services. We're going to start off with the dairy market forecast from Mark Stephenson. Mark Stephenson, he'll share a little bit more about his experience and what he focuses on, how he serves dairy farmers like yourself in the industry. He might be based in Wisconsin, but his work focuses on everything that encompasses the U.S. dairy industry. His official title, I believe he can correct me on this, is Director of Dairy Policy Analysis, and that is at the University of Wisconsin-Madison. So he focuses on research and outreach activities related to the dairy industry, evaluating these prices and how it impacts the economy and the economy, vice versa. So Mark, I'll let you take it away.
Thanks, Julie. I promise to make it a relatively short outlook, but first question, is 2020 really in the rearview mirror? Calendar is, but maybe not quite all of the impacts that we've seen from 2020. I think we've got some good news that, for the COVID infections, it looks as though we're past the peak of our third wave of COVID that's been in there, and we're starting to pull that down. You can see that over on the right, but COVID's not done with this yet. It's still going to take some time before this is all through, and the impacts of COVID on the market has really been amazing in bad ways and good ways. So we'll cover a couple things pretty quickly. 2020 was a better milk income year than we thought. Milk price was not as good as 2019 on average, but we had some additional sources of income out there. For farms that signed up for dairy margin coverage at the 950 level, and I do encourage folks to do that, I think that it's such an inexpensive safety net that for smaller farms in particular, it may be adequate, but larger farms, it's not. But it is going to net overall milk production that was covered at the 950 level, something like 67 cents a hundredweight this year. But on top of that, we had CFAP payments. Those came in all 4 quarters, and we averaged something like $2.45 on CFAP payments. So total income related to milk production was about $21.36 in 2020, and that was the best we've seen since 2014. The pandemic prices haven't been as bad as we thought they were going to be last April and May, but we're getting a lot of milk production now, and I'm not sure how much of that we're going to be able to handle, really. Our milk powders are clearing markets for us. We're exporting those, but butter stocks, although they've been drawn down, are primarily a domestic product, and those stocks have been growing. I'll show you that graph just a minute. We've had the farm to family food boxes. Those have caused some tightness in cheddar markets during a good portion of 2020. We've had surges in demand for cheese products to fill those, and we have been able to do that. They've kept the inventory swept out that we saw built last year during, say, April and May. But those kind of surges that we've had in demand have taken us all the way from $1 a pound on the CME for cheese prices last April 6 weeks later, they were $3 a pound, a high price that we've never seen before. So we've had such incredible volatility this past year. Even though the average prices may look like I could live with those low prices have been really tough on folks. And all of this COVID has put not just the US, but much of the rest of the world into worldwide recession. An estimate that just came out from a Worldwide Economic Board was indicating that gross domestic product across the globe was down about 4%. So, this means that we're going to see some continued disruptions in supply chain. We have a concern about butter stocks. If you take a look at this graph, it's showing you what our normal or, recent normal seasonal patterns have been. You see 2017, 18, and 19 all in those gray lines. And you see 2020, the stocks building, same seasonal pattern, but it's higher everywhere. And we just got yesterday another cold storage report, and you can see what happened from November to December. Butter stocks grew rather substantially. So this is a product that's had big demand domestically, but we aren't keeping up. Fat production has been high. And that would normally be a good thing, but we're going to have to find markets for this butter. One of the places we may find those markets is globally. This is showing you three major export competitors, the US there in red, with our global butter prices. And you'll notice in blue, the price for butter from Oceania, and in the green line from the European Union. Our prices right now are competitive. If you look back toward the end of 2019, you'll see that we were very competitive for a short period of time. But in early 2019 or even late 2018, our prices were well above those world prices. And at that point in time, we became a destination for the EU in particular sending us butter. So we've got to be in a competitive price position, and we are right now with butter. I think we'll move some of this, but it's not all going to be eaten domestically. Cheese stocks. The other thing that was a big surprise yesterday, these are American cheese stocks. The red line is showing you that big uptick that we had yesterday's report from November to December. So those stocks, while not massive or overburdening, are big and growing. And this is a concern as well. Well, we're not always competitive with cheese prices. We certainly weren't through much of 2020. Our prices were way above the $1.60 to $1.80 range that would put us competitive on world markets. But those prices have come back down into alignment, and we're at a place where we probably will be able to sell some cheese into world markets as well. And we'll need to, in my estimation. Powder prices were always competitive. We export more than half that product, and those prices are going to have to be down there at always competitive levels. And we are selling more than half of our skim milk powder that's produced in this country overseas. But you'll notice on this graph that's showing you a percent change in milk production. Again, US in the red line, and the US plus other competitor export countries like the European Union, New Zealand, Australia, and Argentina are in the gray line. We all had a similar pattern with a decline in milk production back in April, May, very sharp decline, and then we've come back up. US was more extreme. We had a lower low than the rest of the world did. We are rebounding faster than the rest of the world. But the point is that all of us are putting more milk on these world markets. So that's one of those cautionary tales about will we have enough demand for all of these major milk producing countries to find export markets for product. Look what happened to milk production. This is milk production in millions of pounds per day over time. Seasonal pattern there. Normally, we would have expected a peak around May, and actually, because we had base excess plans put in place, our milk production contracted, and substantially, from the track it was on. First quarter of the year in 2020, we had pretty big milk production going on. But after those milk prices rebounded and demand for milk in cheese plants and other places came back up, so too has milk production, and we're officially back in big milk production territory. This graphic doesn't have the last month on there of December, but it's well up, and I'll show you a percent change graph. This is how we're doing it. You'll notice the 2020 line that showed with base excess plans in place, we began to reduce cow numbers April, May, and June. We hit the low point of cow numbers, and after that point in time, we began adding animals to the U.S. dairy herd, and we're officially piling capacity on now. We're well above where we were a couple of years ago, 3 years ago, even with dairy cow numbers. So we've got a lot of animals in the herd ready to produce milk. Farms also softened the ration to dairy cows, and you'll notice that milk per cow per day declined in May as well. So many farms got rid of dairy cows, culled them to reduce that milk production. Other farms also reduced the ration intensity and lowered milk production per cow, but that too has come back with a very strong rebound. So altogether, we've got pretty big numbers. That area that I just showed with the yellow band in there, from 1 to 2% is sort of what we need to match our growth in domestic consumption annually. A little over 1% will usually do that for us. We're consuming a little bit more total milk production per capita, and we are growing population. So, 1.5% is comfortable. If we're north of 2%, this means that we've got to have exports and substantial growth in exports. Otherwise, we're going to have to see prices decline pretty substantially. We can't eat our way out of the above 3% growth that we've had. In fact, we've had above 2% growth since September of 2020. So is this really optimism or pessimism? This is a chart just showing the class 3 and 4 contracts for February milk production over time. Class 3, started, in the low $16 ranges, and it waffled around there, got up about 17, and then it climbed rapidly from December to where it hit a peak of north of $19.50. In fact, I think the high point was $19.71, but it's also collapsed since then about $3 a hundredweight back down to that $16 range. And today it's even somewhat lower than that. Class 4 has been low, steadier, and declining a little bit, softening a bit. And this has been a bit of a, the export market for those products has been what sets the tone and clears our U.S. markets of surplus product. Cheese has floated on domestic demand, but I'm not sure it's going to be able to this next year. So my forecast factors, we've had optimism about things like food box programs. That's moved a fair amount of product. We're in our 5th program right now. The first round of offerings was only $350 million instead of the $1.5 billion that the last stimulus package made available for food programs. So we'll have more than 5 food box programs. We're likely to have 6, 7, or 8. We'll see how many they let out there, but it was a disappointment to dairy industry. Grocery store sales have been good with our return to home cooking, but they've slowed down their growth now too. Restaurants and schools are trying to reopen. Those are channels that are important for dairy. And, we've got some export opportunities that we've been working on, and hopefully we'll be able to clear our markets with some of those. We, of course, have effective COVID vaccine, better testing going on, but it still has to be administered. We've got a big concern now about whether that vaccine's administered and how quickly. A few things like variations on the virus that are, have us questioning whether the vaccine will be completely effective. And then we also have a US and worldwide recession to be concerned about. We've also got some new Class 3 capacity, new plant in Michigan that's online now and continuing to be filled up. We've got a couple expansions, major ones in the I-29 corridor and one in Wisconsin, and more minor expansions across the country. So we can make some more cheese and we can take some more milk. I think the real question is, do we have the customers for that? And the answer can be yes, but it might mean that we have to clear that extra class 3 at something like world market prices and not floating on those high $2 domestic prices for cheese. This was my forecast before yesterday's reports came out. And that relatively flat line out there showing you a US all milk price somewhere in that $18.50 range does not reflect the fact that I think it's going to be a non-volatile time period. I think it is going to be volatile. I just don't know when volatility is going to occur and how big those things may be. I think it may average something like that. I've actually pulled 30 cents out of my forecast since this slide was here. So I'm having to soften and tone down now based on the milk production reports that we've just seen. And the last thing I would just leave you with, have you managed your risk? I think the dairy margin coverage program is a no-brainer. Just sign up for all the tier 1 you can at the 950 level. One of the things that was included in the last stimulus package was that dairy farms will be able to increase their historic production up to 5 million pounds. So if you're a farm that, say, had a historic production level of 2 million pounds of milk production, and you've since increased to about 4 million pounds, you'll be able to take, I believe, 75% of that additional 2 million pounds of production and add it to your other one. And you can do that all the way up to 5 million pounds. So that will give you a chance to buy more coverage under DMC for at least smaller farms. If you're a larger farm, you got to watch for the opportunities in futures markets. Those price opinions have been moving around quite a lot. If you're going to use something like LGM dairy or dairy revenue protection, you've got to look out more than a quarter. And as I said, I think futures markets are using a naive approach right now. We don't know when we're going to have things impact the markets for volatility. And so they're tending to give us this fairly flat sort of price forecast out there. But if you're looking in the current quarter, the quarter that's just ahead of us, then you might find some milk price opportunities that you do want to grab. And I know that, we're going to have an opportunity with our next speaker to look at some of those opportunities and ways of doing it, but you might be able to put a floor under an attractive price for your own operation. There's not a lot right now, perhaps, but there are some opportunities for farms to lock in this risk. You really are going to need to do that. So that is what I've had, Julie, and I'll be here for a little while to take some questions if you wanted to.
Sounds good. Thank you, Mark. We appreciate that market forecast update. And I think you kind of hit it on the head that this past year was incredibly volatile. And even though 2020 is behind us, that volatility is certainly not. So at this point, I'd like to welcome Travis Glaser, who's with ARM Services, or also the acronym, correct me if I'm wrong, Travis, but Ag Risk Managers or Management Services. And just to reiterate the fact that FarmFirst leadership saw this need, there's so many questions out there and so many experts and opinions and tools and resources. And when it comes to marketing or managing the risk, when it comes to your milk price, there's certain things that you can do, but they can be so complicated. But ultimately, knowledge is power. And we wanted to bring that to not only our members, but as many dairy farmers as possible. Again, that's the reason of this webinar and the reason why we encourage everyone to ask questions that they can. So we'll save questions till the end. Please use that Q&A feature, or I've been receiving some emails as well. And Travis will kick off his PowerPoint here soon. But please keep that in mind, everyone that's attending. What is it that you might not understand about these programs, or what ways could you feel more comfortable about using them or how they've panned out for others. But we're excited to have Mark and Travis here. Travis will now go into some of the options that you might have and how these products have performed and how they can best serve you today and into the future. So Travis?
Yeah, thanks, Julie. As Julie said, my name is Travis. I'm one of the owner and agent at Armed Services up here in Barron, Wisconsin. We're servicing clients in a multitude of states across the country, using some of these tools, DRP and LGM Dairy. And I really appreciate the opportunity to work with FarmFirst and be involved in the webinar today with Mark. Always appreciate learning and getting insight to where the markets are moving. With that being said, I think one of the things we do have to take a look at from what I took from Mark is, he said the average prices look to be good, but the low prices have really hurt us. And I think that's one thing we could see in 2021 as well. As you look at the first half of the year, this is as of yesterday because the markets are changing so rapidly. We do have some opportunity here at some decent prices in the future and even better prices as we look out further. As I look at the future of the milk market, it is hard to tell where we're going. I mean, I just can't project it. And if you know anyone who can, let me know because we're always hiring. Just to show you guys, there is some opportunity there to get some kind of marketing plan in place on our milk using, one of the following options. I do agree with, we got dairy margin coverage at the FSA. We have the insurance products, the DRP, the LGM, producer-sponsored purchase programs, and then our futures and options that we can take a look at. I do agree with Mark. I think the producers should definitely get in and sign up for the 950 coverage up to that 5 million pounds of milk. I think it's critically important. It's a great opportunity to get some of this milk covered. And I do believe we've seen a decent amount of payments out of that program. I do believe December is going to pay somewhere in that $2 range. And as things continue here for January, February, I got to believe we'll see some payments there too. Producers over 5 million pounds, definitely consider the $5 range. It's maybe not great coverage, but it is ultra cheap coverage at a half a cent. And then, as I said, in December, we should see somewhere around a $2 payment. I don't know that for sure yet, but I'm guessing somewhere around there. The other things that we're more involved in are, the federally subsidized insurance products. And, going back to what Julie said, there's so many options and so much opportunity out there. And we hear it from producers all the time it's confusing to me. I tried it. I didn't really understand it. And I think that's the goal of our agency and all of our agents is let's bring an education-based approach to these products. I don't want to come out and strong arm someone with fear or greed and say, you got to do this, you got to do it. But let's develop an understanding together and try to work through these programs. Both of these programs establish a floor on your milk. They leave the top side open, and I think that's a big deal when we experience market volatility. LGM Dairy does establish a ceiling on soybean meal and corn, and that's been a pretty nice thing to have over the last few months as feed prices have really taken off and rallied. With DRP, we don't have a feed component. LGM is grouped into 2-month periods. We can look at April, May, or a May, June, where DRP is quarterly. It is Jan, Feb, March, April, May, June, July, August, Sept, and October, Dec. So that is one major difference between the programs. And it's an important difference as we see sharp rises and falls in the market. If we see steady movements, it maybe not as critical. LGM is using class 3 only. DRP does allow you to look at class 3, class 4, and component pricing. If you're going to dive into the class 4 or component pricing, I would definitely make sure that you have a strong understanding of what you're purchasing and how it's working. And some of the farms that I visited with, a lot of times what I have seen is just it's a higher price, which means a higher premium and a higher deductible then. So just tread with caution. I mean, understand what you're purchasing is my big message there. You know, DRP can be purchased more often than LGM dairy. So you can purchase DRP most days with the exception of milk moving the limit or a reporting day. Some people look at that and say, it's wonderful because I can make this decision and watch the market. You'll see over here, there's less emotion in the LGM decision. LGM is purchased the last Friday of the month. That is actually this Friday. So we'll be doing some signups this Friday, quite a few. I like the fact that LGM has taken the emotion out of the decision. Numerous times a producer will call me and say, oh, you know, second quarter looks great, third quarter looks great, let's get that on. And we purchase it and we wake up tomorrow or we get to noon the next day after it's too late to make any changes and milk's rallied 50, 60 cents in a day and the next day again. So I really like taking the emotion out of that decision. Another thing to be aware of on DRP, and I feel it's not talked about near enough, is the yield adjustment factor. And it becomes a pretty significant deal because we have this projected production per cow. And, you know, when milk production is up, prices tend to fall. And if you're purchasing a DRP product and all of a sudden milk is coming down and you got this indemnity coming to you, well, it could be because the production per cow numbers are up and it will offset your indemnity, which ultimately could hurt you. There are some one-off situations where it's been just the opposite, and Mark did touch on those when we were looking at that April-May time frame. And what I've done here, just moving into this a little bit further, is when DMC came about, the RMA said we can't be purchasing or using DMC and LGM dairy. They said, you know, we can't have two margin programs. And so they really wanted to focus people into DRP. You know, I do think ultimately both programs work very, very well. There are times that LGM does offer a real clear advantage, but they are both good programs, and I don't want to deter people from using them. Again, it just comes down to understanding, you know, what you're purchasing, when you're purchasing it, and how it's working for you. Then in the midst of this DMC and only being able to use DRP, they changed and said, hey, you know, we can use both of these tools, you just can't overlap them. So we had built a study back in 2010, started it into 12 on LGM, and we just started building a DRP study and put the two together. You know, just as I focus here a little bit on this LGM, you notice that as we're moving along here, you know, net result of 17 cents, that's above and beyond the premium in the farmer's pocket, no wait, 3.55 and 9, 10 cents and 10. And then you get to 2011 and you had to pay a premium. Average premium costs, they do vary, but for our study, we're using a 25-cent price. That's based on market volatility. But in 2011, you did pay the premium, and that's because we had milk go from $15 to $18. So, you know, you got the top side open. You were able to put that in your checkbook and move on. You'll see here in 12. 12 is an interesting year. We did have milk prices come up from $16.65 to $17.43, and you were still able to net 37 cents in your pocket. And a lot of that had to do with the feed rising in price. 2013, net 12. 2014 was a glorious year for dairy. Milk went from, you know, at $17.93 to $22. So you did have to pay the premium there, but you left the top side open. You know, 15 and 16, you made some money. 2017 was probably a difficult year. Milk just did not move. So we were spending money on premium that just wasn't getting us anything. 2018, we saw a net 34. And then, you know, 2019, we got some money. Some of the months milk was really good, and other months it dropped, and that gets into that. The average was okay, but there was some definite steep drops where we did get a little bit of money. Unfortunately, it wasn't enough to cover that premium. And then in 2020, I just want to focus here a little bit more as, you know, I have no idea what market volatility is going to be like. I just know it seems to get more and more volatile all the time. I got this highlighted in blue because our agency, we kind of changed our plan of how we were doing LGM and what our study and our plan showed. And for producers who stuck with us in 2020, which truthfully started back in 2019, putting that floor on in the future months, they were able to net a 28 cent per hundredweight gain in 2020. In DRP, there was some payments in DRP, but at the end of DRP, you can see here that it was a negative 6 cents out of pocket. Like I said, both of these programs are really good. They do a great job for us, but as markets move steeply and sharply, LGM may come out as a clear winner based on today's program. Here's a little bit of a diving into that a little bit. We're looking at second quarter of 2020. And one of the things, I'll just stop here a little bit before I dig into this. One of the things that I want to make sure that our agents and our agency is doing is digging into this data deeper and deeper. We don't want to come out and just say, yep, you need to buy this, you need to do it. Well, we want to have proof. Why should we do it? When should we be doing it? And how is it working? I mean, it is an insurance product. You will pay premiums at some point, but I want to have the confidence to come to you and say, here, this is why you paid the premium. This is why this happened. Not just, yep, sell it and walk out the door. So here, Fran, one of our other agents and owners, came up with a study here where he just picked some random dates from July through February, July 19th through February, purchasing a DRP product. You can see the average premium was about $3,600. In doing that, we did receive an indemnity. The average indemnity was $32,000. There are some bigger ones and some smaller ones. It's just hard to know when you would have purchased that product. The net result, after paying that premium is $28,000. This is one of those one-off situations, though, where milk, the decrease in milk was about $21,000 of that indemnity. And then we actually had lower production per cow through that time frame. So not only did we have milk coming down, we also had production per cow down, which gets you to this $32,000 average indemnity. Now, if you compare this quarter to LGM and our standard recommendation, you can see the premiums are very similar here. Not a lot of difference. Where you start to see major differences is in these indemnities. With LGM, most of our producers who stayed the course, kept consistent marketing plan in place, on a million pounds a month would have received $55,000 through that quarter. The net gain of that's $51,000. And what happened or what caused that? Well, the majority of the indemnity or the payment the producer would have received came from milk. And as I stated earlier, there is a feed component, in that product. And here feed actually did drop. And so it did take a little bit of money away from us. But I guess my point here is just to show you guys that data and the statistics matter, and we're always analyzing, both of these products, not necessarily to say this one's far better than the other, but it's just data that we want to calculate so we can tell our producers where they're at. Then once a producer decides to purchase something, the other thing that we've really tried to do is, where am I at? Producers say, yeah, I purchased this product from so-and-so or from this place, and I have no idea where I'm at. And so we try to give our producers an update of where they are to track it. This happens to be a producer that I work with here in Wisconsin. And in May of 20, he would have purchased protection for November, December milk. He really did focus on December milk quite a bit. And you can see milk, he has $1 deductible, which means milk would per se have to fall $1. It did not fall $1, but what really kicked in here was the amount of meal he had protected. And we had meal raise $100 a ton, which created a negative margin on his farm of $26,000. In turn, he received an indemnity here for $23,000. This is as of you know, a date and time until we get the final settles. I can't tell you exactly what he would have gotten. And then in July, this producer, same producer, said, you know, I'm only protecting 2 million pounds a month. I really need to get up to 3. Let's get 3 million pounds on for these other months. And when you do 3 months at a time, you get an averaging effect. You know, you can see here that milk was up 370, up 634, and up 60 cents. So, I mean, maybe there could have been a small payment here in December, but when you have the months averaged together, it makes it pretty tough to get ahead of that. So just wanted to give you guys a little, show you a little bit about how we're tracking it and, you know, what we're trying to do for these guys. That's kind of what I had on the insurance products. You know, more than willing to help you guys out and help you understand it. You know, I set up a meeting with myself or one of our agents, and, you know, you guys decide if it fits your farm or not. Another thing that our producers can look at is the producer sponsored purchase programs. Premier might offer you the opportunity to contract your milk for a fee of 10 to 15 cents. I just say, be careful what we spend our money on. I'm very adverse to locking in the top side of that milk. And so just tread with caution on that. Last, we have options trading, you know, the puts and calls. Yeah, I'm not an expert. I'm not a broker. I've been working with the milk insurance since 2010. And it is hard to predict the market. I mean, you can't beat being right, but it is hard to predict where this thing is going to go. And I think it's getting harder and harder all the time. Buying options over time are typically fairly priced and occasionally expensive. We're seeing that right now. You look at some of these option prices out there, they're real expensive. And I think it has more to do with the market volatility than anything else. 3 out of 4 options expire worthless. So we're purchasing these things and they're expiring without offering us what we're trying to get. Selling call options can really hurt you. You know, and working with some of the producers who are buying DRP, maybe through a broker or through an agent, and then selling some options to try to put some premium in our pocket. Again, be careful, fully understand what you're doing. You know, we have milk at $17 and we sell a call for 19, 5 months out, and all of a sudden milk rallies from $19 to $24 and you're paying a margin call. And basically you've hard locked yourself at that 19. Then, not that I want to get into this, but a PPD payment comes and you got to take another $3 to $4 off that 19. So just use caution and be careful. You know, does anyone really know the market? I mean, stay away from unneeded risk and manage the risk in a consistent manner is really my message. You know, we can all talk about the market and predict it. I just don't know that anyone fully understands where it's going. And remember, there's some opportunity out there today on the milk side. That's kind of what I had for milk. I don't know, you know, ask the questions you want on the milk side of it. One thing that I had talked with FarmFirst about is just to add a little bit here on crop insurance choices for dairies. It's kind of something that growing up on a dairy farm, coming to work for Ag Risk, which is now ARM, I feel that people treated crop insurance the same. You're a crop farmer, you're a dairy farmer, you buy the same thing. It doesn't matter what you're doing. Crop insurance is crop insurance. I can't stress it enough. If you're out there dairy farming and raising crops, maybe you're selling a little, maybe it's all going for feed. Just make sure you're aware of all of the options that are available. Crop insurance is ever changing. They're coming up with private products and subsidized add-ons. And, you know, just make sure you're getting a fair shot at all of these. You know, here's some personal options I've got here, personal choices. You got revenue protection or yield protection. You know, revenue gives you the difference in the spring and fall price. It is a personal coverage. You can buy levels from 50 to 85%. Revenue will trigger on price and yield. Yield protection will trigger solely on the yield. It does give you some prevent plant coverage and replant coverage. And I think that's important depending on what area of the state or states you live in. Be cautious if you're raising silage corn and buying an RP policy that you could have a silage conundrum, and it's something you won't know about until it happens. And we've seen it here and had to deal with it. Just if you're planting a silage variety of corn and buying an RP policy, just, make sure you fully understand that. Add-ons to strongly consider, supplemental coverage option that came out last year. Definitely look at that coverage level, especially if you're a dairy farmer. It does increase protection from your standard level of insurance to an 86% level. It triggers both on price and county yield, but it pays based on your APH data. And that goes for enhanced coverage option 2. That increases your coverage to a 95% level. It triggers on price and county yield data again, but pays on your APH data. And I think what I'm seeing on dairy farms is, these dairy farmers are putting the manure on the ground, they're following nutrient management practices, and they're typically out yielding a lot of their county. And so you come in and you buy a 75% policy, and I hear it often, well, this doesn't work. I haven't really been getting paid much. My yields keep going up. Here's a real opportunity for you by looking at SCO and ECO. So just take a look at those if you're on a dairy. A couple other options on the crop side for dairies. We call these management plans of insurance. It's an area yield protection or an area revenue protection. These really offer no personal protection on your farm. If something goes wiry on your farm and not at a county level, it could hurt you because these are triggered off county yield and price. Again, yield is yield only and revenue is price and yield. Very cost effective in a lot of areas. Some areas, maybe not so much. They do offer you a great level of coverage, and you do not have to leave strips or deal with appraisals when you have these policies. You still report your production to your agent, but you're able to just put the crop in the ground, go back to the cows, farm, and get the crop off. We do a fair amount of work with these policies, and currently in the stages of analyzing this compared to the RP, SCO, ECO. I do have a little example here of these management plans, just because they are so different. This is a client that I work with in Marathon County, Wisconsin. This is 2019. He purchased an ARP policy. He had 385 acres of grain corn. He bought it at 90% coverage level, 100% of the price. You can see here our price change last year, 2.5%. What ended up happening in the county, though, is Marathon County just really got beat up, and their yield came in at 105 bushel, which left the guy an indemnity of $138 per acre. We had 141 expected, came in at 105. So on his 385 acres of corn, he collected 53,000. What's interesting also in working with this guy, his corn actually yielded about 145 bushel. And so here he was out doing a good job, fertilizing and taking off a decent crop for him. And he was still able to put some money into his bottom line by having this management plan of insurance. Same gentleman, he also had some silage corn. This happens to settle on an AYP side of it. He had 554 acres of silage corn. County expected a 21.3 ton yield and came in at 15.8, leaving him with $142.92 per acre. And his silage ran 20.1 ton to the acre. And like I said, it's a management plan of insurance. And I think it's a great tool for some of our dairies to consider, and I don't feel it's given a fair shot to everybody. So that's what I had today on the milk and the crop side of things. Be more than happy to answer some questions, or if you need me to review something, I can go over that with you as well. Thank you, guys.
Thank you, Travis. Thank you both, Travis and Mark, for joining us today. We're going to dive into some of the questions that people have. So at this time, I'd just like to remind everyone of the question and answer, the Q&A feature at the bottom of the webinar. Hopefully it's working properly. I haven't had any questions come in that way yet. Also, I have received a few via email, so I'll just mention my email address again. My name is Julie Sweeney, and my email address is jsweney@farmfirstcoop.com. So please, you can also send questions that way. Give me a second and I'll pull up some on my phone. So here is a question. Hopefully it makes sense that you can all answer it. So, what is the difference between a trigger price and a revenue guarantee price? What causes them to be different at times, and which is a better reflection of your actual price protection? Travis, I think that's you.
I assume in this question, we're talking about crop insurance. And it gets into some of the things I actually talked about. I think when you have a revenue policy, it's your APH times higher the spring and fall price, and you establish a price guarantee, and it becomes your own. And then I believe what they're talking about on a trigger price, and I apologize if I'm wrong because I'm assuming here, is when they're out buying like an ARP or an AYP at a 90% level on a county-based yield, it sets a trigger price. And so your difference is comparing what your actual revenue guarantee is compared to this trigger price on a county level, or using the ECO, SCO, which adds a little bit of a county to your underlying multi-peril policy. And if they're looking for more clarification on that, reach out to me. I'd be more than happy to see if I can dive into that for you.
I'm sure, I'm confident they're listening, so I encourage that as well. Travis, I would have to say both of you have all this great data, and it's really nice to be able to know what scenarios have played out really well for other farmers, as well as from your experience where red flags maybe exist in certain insurance policies and such. Got a few more questions in front of me. Travis, this one would be for you again. What would you consider to be important pieces to a successful risk management plan?
To me, ultimately, is really understand what you're purchasing and develop confidence in who you're working with, that they've built a solid plan and can give you the facts or statistics to back that plan up. I mean, hauling grain in this year, a gentleman said, I looked into the LGM and that just didn't work for me. I just didn't understand it. And I feel if people would take the time, with our agency or maybe others out there, I'm very confident that within 20 to 30 minutes, we can give you a well-based understanding, educational-based approach to what you're purchasing, how it's performed in the past, and why it works. It's your operation. I don't feel you should have the need to learn everything. So find someone you can partner with that can take care of this side of it for you and let you do the things you like to do.
Awesome. Good. Kind of taking off of that a little bit, how did producers fare who had a plan in place prior to the news of the pandemic? This is specifically talking about last year then. How did they fare compared to the producers who jumped in after the pandemic was started?
Well, I mean, hindsight's 2020. We'll say that first, because I don't want to cause any sore feelings, but our producers that were on our plan or got started with us in the middle of 2019, early 2019, who really, stayed the course and followed the plan, fared very, very well. That one slide I had showed that they would have netted about 28 cents per hundred. What's more important than the 28 cents per hundred gets back to the comment Mark made about average prices look good, but the lows really hurt us. And if you were following the plan, we really took those lows out of the market. we did have a fair amount of producers that called when the pandemic started. Maybe, this thing is coming out in March. What do we do? It's just hard. It's hard to jump in when the market's rapidly crashing like that. I mean, it's very important to develop a marketing plan and stay the course. Mark said that as well. Don't just buy the next month out. We need to be looking out there in the future, and there's some great price opportunity there now. And starting is the hardest thing. Once you get started, it's easy to continue on. And like I said, you will pay some premiums. It is an insurance product. Premiums will be paid, but in the long run, I think you'll be very, very happy. I don't know if you have anything to add to that, Mark, but.
Yeah, I'd throw in maybe just a couple of things. One is, as you've said, you got to have a plan. Okay. So think about something, then you've got to monitor things and then work your plan. So a good example was fourth quarter of 2019, prices were rising. A lot of people that looked at that said, okay, I've got a plan in place. I'm going to put a floor under 25% of my milk production. Prices rose a little more. Maybe I'll put a little bit more of a floor under some more milk production. They were actually working the plan. A number of other people I know that, look at that kind of thing and say, well, the heck, I'll just wait until prices are higher. That's not working your plan. And you can start to miss that, because when prices begin to tumble, you can't chase it fast enough to get in there and secure what you wanted or needed to. So, that's just something that I would say is really pretty important. And people got pretty good payments for those programs in the first and second quarters of the year.
Yep. That actually reminded me of something else that Mark just said. When we were doing these plans, sometimes we get a new person to start with us and they buy a couple of months or they buy a quarter. And then when milk starts to creep up, we often hear, oh, it's going to be a good year. It's getting better. Oh, things are better. I'm going to quit now. Well, we're trying to get a floor in place out in the future market, not in the current market. So we can't make our decision based on what's happening today. We just got to use our plan and stay the course. Consistency is key.
Exactly. I think that's some sound advice. Another question that we had come in. So this is a bit of a longer one. If I need to reread it, let me know. We are a high solids herd and know what mailbox price we would like to lock in. How do we assure ourselves that we will actually end up getting that price or above? We have been thinking about using our basis, which we calculate two ways based on the past couple of years. One is our mailbox minus the class 3 price, usually $5 to $6. The other is our mailbox minus federal order component price totals, butter, fat, and protein and other solids, usually about $17 to $18. Is this a rational approach, or is there a better way to determine how to lock in the price levels you are comfortable with?
When you're looking at these prices, the underlying price out there is the class 3 price. So we can increase components and get a higher price, and it just doesn't exist, I guess, is my comment on that. And truthfully, we have the studies and the math behind this. You have class 3 right now at $17.40, and I can come out here and move components and get you a floor per se of maybe $20 some. Well, at a 95% coverage level on DRP, you've now got a higher deductible. And because we have a higher floor on our milk, we now have a higher premium to pay. And when you look at the study on this, as class 3 moves down, so do those component price. I mean, class 3 is priced on these components. So I tread with caution on that. If you wanted to have a deeper conversation and a better understanding of your question, I'd definitely get together with them, put it into a spreadsheet and show them how that works. We can't get a higher price than what's out there. I mean, it just doesn't exist.
Yeah, and Dairy RP does have a component option. That's something you can do. It tends to be a bit more expensive, but for very high component herds, I think it's something you can certainly look at. The one thing I would say is that with any of these kind of risk management programs, we've got something that we're targeting. Component values, more likely it's going to be a class value or combination of class values, 3, 3, and 4. And the difference between your farm milk price and that price that you've actually been able to try and protect is what we call basis or basis risk. And usually the idea behind any kind of risk management is that basis risk is usually well less than price risk. But we've seen a little bit different happening more recently here with our negative PPDs. That's basis risk, by the way. You know, you can protect class 3, but then you've got a negative PPD in your milk check that is causing your farm check to be quite a bit different than what you thought it was going to be. And this is an unusual time period, but PPDs have been negative and they've been large. I did see in the Q&A a question come in, you know, that was asking about what's the prediction for PPDs in 2021. Right now, if we look at futures markets, it would suggest that January is going to be another pretty good sized negative PPD. Maybe $3 negative or a little bit more than that. But afterward, those are becoming much smaller, still negative until probably the middle of the year. But it's because class 3 and 4 prices are coming together that those PPDs are becoming less negative and even small positives for the rest of the year.
Oh, here's another one. I think, Mark, you can see it. Do you see a product in the future that deals with the risk of large negative PPDs? I'm assuming that means like a risk management product specifically to protect against PPDs.
Well, any risk management product has to have something that we all agree on, you know, that we're going to try to protect against. So for example, we could just say, look, I want to protect against a $16, $18, whatever it might be, farm milk price. Now, potentially you can set up something that's kind of off market, like a swap, you know, to do that. But both the buyer and the seller of that have to understand what it is we're trying to protect. And if you're asking, do I see a product in the future that deals with the risk of larger negative PPDs? Probably not. And the reason is they're very hard to forecast. If we could forecast them well and understand what kind of price floor we were actually setting, then we could perhaps have a product that incorporated more of that basis risk, but it's going to be hard to do, in my opinion.
Yeah, I would tend to agree with that. And from a risk management standpoint, or dealing with, you know, a federal product, they take a long time to come to fruition to get something. And it's not the same at every creamery. So I don't foresee anything that's going to be a standard.
I would strongly emphasize that if you're looking to better understand these products without any type of commitment needed, please reach out to Travis. He's been completely willing to answer all the questions that I have and trying to better understand these for our members. But as well, I think Travis is very forthcoming with the actual data and figures and case studies that they've had. So clearly I'm a little biased, but I think it's important to get that information out to our members and all dairy farmers. So encourage you to challenge Travis to see if he can answer your questions to the best of his ability. With that, Mark or Travis, do you have any additional comments to today's discussion that we've had?
Yeah, I can take a shot at that. The question is, why is there such a large variance in negative PPDs between plants? And, you know, when we have a negative PPD, it is going to be a negative PPD. The real question is, how big is that negative going to be? If no milk depooled, we would still have a negative PPD. If a lot of milk depools, that negative number gets even bigger. But if you've depooled your plant, you now have, you know, you might say, well, what milk price are you going to pay? And the answer to that is whatever they want to. You can pay anything you want and still hopefully get the milk in your door. If that PPD is showing up on your milk check as being different than your neighbors and you're both selling to milk in this upper Midwest marketplace, then the reason the PPD is different is because of the way that the plants decided to show that on your milk check. In other words, the plant is going to probably keep the check printing the same as they've had before, or the co-op, and they will be showing you the component values that you're getting paid. And then the question is, how do I pay out that extra money that I have or would be willing to pay to dairy producers? And the answer is probably in that PPD box in the milk check. So it's likely to be less negative because they're sharing some of that with you, or maybe, it's sharing most of that with you. So some farms get a different payment just depending on who they're actually shipping to.
Okay. Thank you, Mark. I don't think any other questions have come through. So with that, and it's about 12:34, so we've just ran over by a few minutes of our hour-long webinar. I just wanted to thank everyone again. Thank you, Travis. Thank you, Mark, for joining us today.
Thank you guys. Appreciate it.
Definitely. I will send a survey out to everyone that had attended. So we would love to hear your feedback, whether you are a member of FarmFirst or just a dairy farmer that wanted to tune in to today's session. Curious about what you thought of it, what questions you might have once the webinar is over. So look for that coming to your email that you registered with. And other than that, let's hope that 2021 is a much better year than what 2020 was. So thank you so much for joining us today. You all have a wonderful day.